The most common tax deduction is contributing to an employer-sponsored plan because money is in a 403B plan, a 401k plan, or a deferred compensation arrangement, or federal government employees a thrift savings plan. Those contributions most often come out pre-tax, so after payroll tax, but before any federal or state income tax. So that's the easiest deduction that's available to everyone, is putting money into an employer plan, or if their employer has no plan, a deductible individual retirement account.
Taxes are calculated based on a number of different figures. What's most important to know is that your household's total financial picture is taken into account. And so when you're looking for tax advice, there's no advice that can just be based on one variable. Whether you have a part-time job, if you have any rental income, any college education that you're paying for, all of these factors get melted together to take care of your actual taxable liability. So it's important that you look for advice that's custom to you and is not just in a silo.
Our country's crazy tax code doesn't tax everything all the same, so there's a question behind every dollar that comes in. Every different source of income, how that money came to you and how it's taxed is all different. So before investing money, understanding the tax implications as they relate to your specific unique situation, I think it's very, very, very important to understand kind of the rules of the game in taxation before making any type of investment, whether it be stock, bond, real estate, a small business, etc.
Everyone in this country has a couple of different tax rates. And so because we use a tiered tax system, you have a tax rate for the first dollar of income to your household, and then a different tax rate possibly for the last dollar of income that comes to your household. It's important to know whenever you file your taxes what that last dollar is going to be taxed at. That can help you evaluate different investments, and then also know what your effective tax rate is, which is just if you were to divide your total income by the total taxes you paid, what percentage does it come out as? So it can get to be really complicated, and that's where a professional can step in and help you figure all of this out.
When we loan money through the purchase of a bond or an investment in a bond from a municipality, that interest is usually exempt from federal income tax. Now, if that institution of higher learning or that municipality is the one you live in, it will be exempt from both state and federal income tax. And secondly, when it comes to hospitals and certain not-for-profits that offer municipal bonds, it's a way to invest in a tax-smart way and also feel good about where you're loaning money.
So we all know the deluge of information that we get between January and March every year. It's very easy to lose a form or to mark it off as inconsequential. It's important to keep all of those together, and one of the easiest ways that you can check would be to go back to last year's taxes, see what forms you had last year, and then either have a new form for the current year or a reason why you don't have a new form. One little red flag in your mind would be if you opened up any new accounts, whether it's an investment account, anything that would bear interest. Make sure that all of those new accounts you opened throughout the year either have a tax form or you've spoken to someone from that firm and they're explaining to you why you don't have a tax form for it. It's worth understanding your tax returns because you can then make decisions that will help you minimize your tax going forward. Whether it's the child tax credit that you're receiving, an educational benefit, one of the small business benefits, you may be able to impact your taxes in the future based on your understanding of your taxes in the past. Going line by line through that return with a professional will help you do that, and will also help that professional give you recommendations that could benefit you going forward.